Hello everyone, my name is Isia Zun Naraini NPM. 23,411,066 class. Management 23X. Here I will explain the liquidity risk material from the risk management course. Liquidity risk is the risk that arises when an entity, such as a company or bank, is unable to meet its financial obligations when they fall due without incurring significant losses. There are two main forms of liquidity risk. Asset liquidity risk. Difficulty in selling an asset quickly without a significant decline in its price. Funding liquidity risk. Inability to obtain funds to meet obligations or financing needs. Sources of liquidity risk. Some sources of liquidity risk include mismatch between assets and liabilities, mismatch maturity, large-scale withdrawals by depositors, bank runs, declines in the market value of liquid assets, financial crises or abnormal market conditions, excessive reliance on short-term funding. Impact of liquidity risk. If not managed properly, liquidity risk can cause operational disruption due to lack of cash, increased funding costs, loss of trust from investors and depositors, solvency crisis, bankruptcy, decrease in company value. Liquidity risk measurement. Some indicators and ratios that are often used. Current ratio equals current assets, current liabilities. Quick ratio equals current assets, inventories, current liabilities. Liquidity coverage ratio, LCR, specifically for banking, shows whether the bank has high-quality liquid assets to cover cash outflows for 30 days. Net stable funding ratio, NSFR, measures the stability of the bank's long-term funding. Liquidity risk strategy and management. To manage liquidity risk, organizations can do cash flow forecasting, plan cash inflows and outflows accurately, maintain cash reserves, have cash buffers and assets that are easily liquidated, diversify funding sources, do not rely on one type of funding source, stress testing, conduct crisis scenario simulations to see liquidity resilience, asset and liability management policy, ALMA, effective arrangement between assets and liabilities. Regulation and compliance. In the banking industry, liquidity risk is highly regulated by authorities, such as Basel III, sets LCR and NSFR standards to improve bank liquidity resilience. OJK, in Indonesia, applies rules related to liquidity profiles and reporting obligations for financial institutions. Conclusion. Liquidity risk is a vital risk that can trigger a crisis if not managed properly. Therefore, it is important for companies and financial institutions to have a robust risk management system, monitor liquidity ratios, and prepare adequate mitigation strategies.